Good morning, I'm Allie Canal in for Brian Sazi, and you're taking a live look at the opening bells on Wall Street this Tuesday. Etsy ringing the bell at the NYSE, celebrating its transfer from the NASDAQ. And speaking of the NASDAQ, Collegium Pharmaceutical is getting things started over in Times Square. All this as traders digest a fresh batch of big bank earnings and the roller coaster ride that is U.S.-China trade tensions. Now, Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make the best decisions with your money. Let's get a quick check on the major averages as we kick off trading and send it down to our own Brooke DePalma, live from the NASDAQ in Times Square. And Brooke, U.S.-China trade tensions, those renewed tensions there, spooking markets just a bit this morning.
Good morning, Allie. That's right after that market rally on Monday, following a slight market sell-off on Friday after President Trump threatened 100% tariffs on China, then pulled back on Sunday, causing that rally. Now we have this renewed conversations around this tension between the U.S. and China, and that's causing all three major indices to fall lower this morning. Taking a look at the YF Interactive, we do have the NASDAQ leading the downward momentum, down about 1.5% at the open here, largely away from that record high that we saw just a few weeks ago. The Dow also moving lower, down about 0.8%, and the S&P 500 down about 1% at the open here. And if you take a closer look at the heat map across the YF Interactive, the Dow mostly in the red this morning, falling lower by some of those that gained the most momentum on Monday, like Nvidia and Amazon. I also do want to point out, though, Walmart, because that stock is up 1.9% today. This stock has had quite the run year to date as it's rallied around this idea of convenience and e-commerce and the double down on that. And now today we are getting this announcement from Walmart that they're announcing a partnership with OpenAI. They're saying that this is going to redefine how customers experience retail. The CEO saying for many years, e-commerce shopping experiences have consisted of a search bar and a long list of item responses, and that is about to change. There's a native AI experience coming that is multimedia, personalized, and contextual. That's what the CEO, Doug McMillon, said within this release this morning. They say that this OpenAI partnership will allow AI-first shopping from search to conversation. It'll have more of that multimedia experience, and also they're leaning into agentic commerce, saying that this is where AI shifts from reactive to proactive. And so that's something we'll take a look at. But once again, that stock moving higher in this pretty bleak picture. JPMorgan also falling lower. Goldman Sachs really leading the downward momentum this morning after those both reported earnings this morning. But despite that, you do have some of these consumer staple names moving higher, including that Walmart move and Coca-Cola, McDonald's. But once again, taking a step back, all three major indices in the red at this open.
Yeah, Brooke, and OpenAI has announced quite a few strategic partnerships over the past several weeks. Thanks so much. Well, lots to get into today, and here's what we're watching. Earnings season is officially in full swing. Third quarter results kicked off in earnest this morning after a few early reports last week. Overall, growth is expected to cool from Q2, but still remains solid, with S&P 500 earnings projected to rise about 8% year over year. That's according to FactSet. And it's a big day for the banks. JPMorgan Chase, Wells Fargo, Citigroup, Goldman Sachs, and BlackRock all reported before the opening bell, and investors delivering mixed reactions. We'll dig into the results and what they signal for the broader market. Here to break it all down, Lale Akinar, eToro Global Market Analyst, Michael O'Rourke, Jones Trading Chief Market Strategist, and Yahoo Finance Senior Reporter Brooke DePalma is also with us. Lale, I want to start with you, because before we get into some of the specifics that we're seeing with these earnings results, broader picture here, you noted that breadth has been deteriorating a bit. We have the geopolitical risks in the background, the government shutdown entering day 14. How critical is this earnings season to offset some of those larger looming headlines out there?
Look, I think we are still thinking that fundamentals are intact. Obviously, the monetary policy started easing as well. The fiscal policy will be increasingly felt in the macro environment. And actually, the banking results so far do tell us that, the deal activity is still there. There is robust trading happening as well, and healthy credit conditions, which all tell us that the macro backdrop is quite positive. yes, I think the market is priced for perfection, and any increase in U.S.-China trade tensions will lead to more volatility. But we say to our clients that, look, 100% tariffs on China would mean a 250 billion increase in tariffs. That is not doable. They're not sterilizable by fiscal policy, and China has the leverage here. So again, expect increased volatility, but the macro backdrop is quite positive.
And Lala, you just said that markets are priced for perfection. Does that make this a make or break earnings season when it comes to the sanctity of this rally, maintaining that momentum, considering how stretched valuations are at the moment?
Sure. Look, I think what we will look at is the breadth of strong earnings, whether again, other sectors will catch up with strong tech sector as well. Obviously, S&P 500 is expected, the earnings is expected to be around 8 to 9% in Q3. And that will, if that is going to happen, it will fuel risk appetite and help stocks shrug off the macro worries right now as well. But again, there's a high bar to clear, but we do expect a fresh boost to equity market momentum when that's when the breadth of the strength moves further into other sectors.
And let's talk about that bar and the earnings that we received this morning. Brooke, you've been looking at all the big bank players. What stood out from you from those results?
Allie, those record highs back throughout this third quarter really stood out to me as the momentum behind most of these key earnings reports. Citigroup, JPMorgan, and BlackRock pointing out record or best market revenue that they've seen in quite some time. Citigroup saw market revenue for the third quarter grow by 15%. We also have JPMorgan seeing their market revenue grow about 25%. And BlackRock noted a record quarter for iShares ETF alongside private markets and cash net flows. And I think it's worth pointing out that this is a market that we've been covering over the past, few months that has been truly resilient, has really pushed through with this AI rally. And now we're really hearing from these banks the influx of investors looking to get in on this rally that we've seen so far. And that's what really stood out to me this quarter. I also do want to point out Wells Fargo, because that stock moving higher this morning, despite the slowdown that we're seeing, or rather the laggards that we're seeing from the other big banks. And that's because of that strong loan business that they have. They're the fourth largest lender here in the U.S. And that momentum is certainly something I'm keeping an eye on, especially in this environment where consumers are seeking out or perhaps returning to bigger ticket projects. They're also, maybe looking to cash in, or rather, be able to use credit cards within this environment amid this uncertainty as well.
And JPMorgan CEO Jamie Dimon, speaking on the call, his comments are always closely scrutinized, but he said the economy remains resilient, but also warned about tariffs, deficits, worsening geopolitical conditions, and high asset prices. And Michael, that really captures the tension that we've been seeing. And I'm curious, from your perspective as a strategist, how do you make sense of that dynamic?
Well, there is a lot of exuberance in this tape. There's massive retail engagement. Definitely at the strongest level since 2021 during the meme stock frenzy. Could be the strongest retail engagement ever. So that's what the summer has been. And that also obviously feeds into the rich valuations out there and those risk factors. And I think what you're seeing in Jamie Dimon's comments, where he does tend to be cautious, because, when the U.S. supertanker reverses course, it's slow. It's hard to get it back on course. And what you're seeing is these little slowdowns, whether it's a job market slowing, that slowdown's been going on over the summer, whether it's auto delinquencies rising. And now we're looking at a situation where we have a government shutdown. So we really don't have data, we don't have the traditional government data to go on as far as formulating policy going forward. So I think those are the risks that are in tension with these high valuations we have out there.
And Michael, Brooke was just talking about the loans business for Wells Fargo, and consistently you're hearing from these banks that their customer base remains strong and resilient. However, a lot of those customers are those high-income consumers, and we still have a very bifurcated landscape. So what's the economic risk if we have one cohort of consumers, those higher earners, really propping up the broader economy?
So, I mean, it's very similar to what we see in the stock market. We have a very narrow leadership group in the economy. This has been going on for some time, though. Like if you look at the dollar stores, or even when Walmart has reported earnings in recent quarters, and Target, they've talked about lower income consumers feeling stressed, but they talk about their consumers being value seeking. And that has been a trend that's probably been going on for more than a year now. And when you look at the stock market today, we see it's very top heavy, and the Magnificent Seven names they're driving earnings and they're driving performance in the index. And you're seeing other stocks be left behind, or they're definitely not getting the valuation premiums those mega cap names are. And so you just have this narrow cohort leading the stock market, and you have a narrow cohort of consumers driving the economy.
And Brooke, Michael was just talking about consumers seeking out that value. You've been reporting on this for quite a bit of time now. What have we learned so far about that movement? And what are strategists saying when it comes to the rest of earnings season and some of those key consumer staples that we'll report?
Yeah, well, certainly all eyes will be on those companies that have outperformed this environment. We truly have this bifurcation, as you had noted, between that high-income consumer really holding out the momentum and Walmart really seeing a gain across all income cohorts. What we expect to hear for the rest of this earnings season, and what we have already heard from companies like Delta and PepsiCo, United, set to come out this week as well. What we've heard, though, is that once again, this high-income consumer really willing to splurge on this premium experience like at Delta. Then you have PepsiCo saying that low-end consumer is really looking for affordability, that they're stretched by inflation. And then when you look out, we expect to see, this is a key season for those retailers. This is the big holiday season. And yet what I'm hearing from so many sources is that consumers are really heading into this next few months really stretched. They're really budget focused and really value oriented. And so all retailers and all companies really have to lean into this consumer that is, really stretched by that higher inflation that we're seeing right now. Despite the fact that most tariffs, haven't even been passed on yet. Goldman Sachs was out with a report on Monday saying that by year end, about 55% of the tariff impact will be passed along to consumers. So we'll have to wait to see more of that.
So Lale, a bifurcated consumer, a bifurcated stock market. On a sector basis, the financial sector is up around 9%. Tech is up over 20% since the start of the year. What sectors do you have your eye on, and how do you expect earnings to maybe change the narrative heading into year end? Or is it just going to be more of the same with tech the outperformer here?
As I said, I do look for any signs of earnings strength broadening across across mid caps and small caps. We think that actually mid and small caps are going to benefit from rate cuts because they are very reliant on short-term debt. They will benefit from the fact that they can expand their R&D thanks to the tax bill. And don't forget that there's 150 billion additional consumer aid that will come in the new tax season in 2026. That tells us that actually in the small to mid cap space, places such as home builders, banks, consumer discretionary, mid cap R&D intensive firms, they will get a boost in the next few quarters. So I will be looking at that. I will try to see whether guidance reflects this.
Yeah, and expected Fed easing continuing, also anticipated to be a boon to some of those small cap names. Lale, Brooke, Michael, stick with me. We have much more opening bid coming up on the other side of this break. Now for our stock of the day, rare earth stocks. MP Materials, the largest rare earth producer in the Western Hemisphere, is down now after 2 straight days of gains and closing Monday at a fresh record high. The sector, though, has been up since Friday on reports that China is adding new export restrictions on rare earth minerals. That's stoking another round of trade tensions between the world's 2 largest economies. China controls nearly 70% of global rare earth mining and close to 90% of processing capacity. That means any policy move from Beijing can quickly ripple across industries, from electric vehicles and clean energy to even the chips that power AI. Still with me is my roundtable for today, Allie Canal, Michael O'Rourke, and Brooke DePalma. And Brooke, I want to start with you here on the moves that we're seeing in some of these rare earth stocks, because a lot of these policy-linked trades, they're gaining a lot of attention this week.
Yeah, we've seen some major moves when it comes to these rare earth stocks over the course of these past few days. We had critical metals jump more than 36% in the pre-market trading. U.S. rare earth was up about 11%. MP Materials up about 8%, as well as others like Energy Fuels and Neocorp also rose about 14 to 15%. And this really is based upon this notion that Beijing's new export controls on rare earth are really designed to essentially force the U.S. to drop these restrictions on selling these chips to China. And so it really is part of this larger conversation undergoing and the impact that these rare earth restrictions could have, and investors really looking to gain when it comes to these specific stocks as well.
Now, Lala, you've said China's rare metals ban could dampen the AI revolution. Walk me through some of that concern and the broader implications there.
Sure. I think, first of all, the market does think that actually this could trigger a fear of supply squeezes, if you will. The fact that they're obviously very dominant in these exports. And also the market is pricing in that the US will simply have to accelerate its efforts to build an independent rare earth supply chain. And these are very important materials, obviously, for magnets used in EVs, in defense, in AI, and in critical tech. And therefore, you could see that the market is being a little cautious in terms of how they price in its effect on the big tech. I also see investor sentiment being affected by this notion of capital rotating into the more real assets, which have strategic utility, and hence the capital flow that we are seeing at the moment. But yes, I think the volatility does tell us that the market is concerned about what it would mean in the short term for the AI trade.
And speaking of volatility, crypto has been on the move quite aggressively since these renewed U.S.-China trade tensions. And this is coming as gold is at a record high. Michael, you've been writing about the so-called debasement trade, which is essentially investors losing confidence in central banks and shifting towards hard assets. Is crypto part of that story at all?
Well, it's been part of that story and been part of that trade. But I actually think that trade is probably has a lot more hype to it than substance. So, like I said, there are underlying notions there, whether it is, expected central bank easing, whether it is, these geopolitical concerns, whether it's fears about devaluation of the dollar or, American exceptionalism being over. What we've seen is this euphoric run, especially in things like, gold and silver, obviously both hit another set of record highs this morning. But, I think a lot of this, goes back to the pandemic in 2020, when the central bank wound up doing a massive QE program, more than doubling its balance sheet. And where we are today is we're reversing that process. You just don't see it on a daily basis. But that has, that lack of confidence in governments. And again, that goes from everything from the elections we see to government shutdowns, the inability for governments to pass budgets has fueled this trade thus far this summer into this fall.
And speaking of record highs, let's turn now to our question of the day. Are we in an AI bubble? A new Bank of America survey shows a record share of global fund managers now say AI stocks are in bubble territory. That's the highest reading since the boom began. Plus, JPMorgan CEO Jamie Dimon warning that a lot of assets are entering bubble territory. Still, big tech isn't slowing down. Google just announced a $15 billion investment to build a massive new data center hub in India. That's its largest outside the US. And while broader markets are lower, AMD is actually popping today on a new chip deal with Oracle, underscoring how much investor demand there still is for AI infrastructure plays. So, Michael, quite simply, I'm going to pose this question to you first. It's the question of the year. Are we in an AI bubble?
I absolutely believe we are. And I'll give you an example. You just talked about Google doing a big deal that's $19 billion. In the past month, we've had OpenAI, a company that's on pace to do about $13 billion in revenues this year, announce about 1.5 trillion in commitments over the next several years. So it's interesting when you see the major hyperscalers, whether it be Google, Amazon, Microsoft, Meta Platforms, they're not announcing, deals worth hundreds of billions of dollars now. So I think that's where investors should recognize there's a disconnect. Well, I also think that's going to be the big story for earnings season. Those major hyperscales will report October 29th and 30th, right ahead of the November 1st potential China tariffs. And it will be interesting. For the past couple of years, they've continually increased their CapEx guidance. And again, based on the level of OpenAI deals we've seen now, are we going to see that type of move from these guys? It doesn't seem likely, but it'll be interesting to see how it plays out.
Lale, do you agree with Michael there? Are we in an AI bubble?
I wouldn't call it an AI bubble. I think we've certainly passed the early discovery phase into what I would call pricing perfection. Investors price the story over the price, and that could mask pure execution, especially for some of the smaller cap firms. However, I don't think that we are seeing a manic investor psychology. I think today's mood is quite optimistic, and there are some elements of FOMO as well, but I wouldn't call it universally euphoric. I think these tech firms are quite strong in terms of their balance sheets, again, and it is a price for perfection story rather than a bubble story.
And Brooke, we just heard from our panelists two different views, and that seems to be the messaging on Wall Street that no one really knows. When you dig through a lot of the strategist notes, is there a common thread when it comes to what some of these analysts are saying, or at least how they're describing this potential bubble?
Yeah, I think that the way to categorize this is all eyes are on the guidance and the outlook that these companies are providing, and what exactly when exactly they'll see the return. I know, Allie, you and I have discussed this as we discussed yesterday. The timeline for some of these initiatives are years out. And so it's really critical to understand from an investor's perspective and what we're hearing from different sources, exactly when we'll see the return on these major initiatives that are being announced. And within the quarter itself, within the third quarter, analysts, as Leila had pointed out, are really pricing in this, return on earnings. They're really baking in that return on investment. And so I really think that this outlook will be key, especially as we head into that Q3 earnings season. And we're already in it now.
And Lale, to wrap this up, it feels like investors have lost a bit of that buy the dip instinct, particularly when it comes to tech. What's your view on that? Are investors becoming a little bit more sensitive to the valuation story?
Sure, I think I don't agree that investors are not buying the dip at the moment. I think, yes, the starting point is too rich. Valuations are already very high, and it's really hard to find dips that look like bargains. But at the same time, I do expect that, again, there are several parts of the cap sectors, such as, again, as I said, small to mid caps with very good balance sheets that are going to get a tailwind because of the incredible positive macro backdrop coming from both the fiscal policy and also monetary policy. One thing that I would caution is the market is underpricing inflationary pressures, right? So I think it could be the case that actually the Fed won't be able to cut say 5 times as the market is pricing in by the end of 2026, and that would create volatility. But that wouldn't change our thesis that there are parts of the market still undervalued, and that will get a tailwind because of the positive macro backdrop.
Yeah, we'll be receiving that CPI inflation report next week. But Lale Akinar, Michael Overrook, and Brooke DePalma, thank you so much for joining today. Well, coming up, Yahoo Finance's Market Catalyst, we bring you the news behind the market moves for the trading day. You won't want to miss it.